Transition Advisors. Our webinar today is Valuing Accounting Firms for External and Internal Sales. Before we begin, we'll need to cover just a few important items. First, please close any other programs running on your computer. This will help to ensure quality presentation and reduce any audio issues. Transition Advisors LLC is a proud and approved sponsor on the National Registry of CPA Sponsors per NASBA. In order for you to receive your 1 CPE credit for today's webinar, you must complete 2 requirements. The first is that you must participate in 3 out of the 4 polling questions throughout today's presentation. And please note that GoToWebinar does monitor your participation in the polls. Next, you will also need to complete an online evaluation after the session. And if you registered for today's webinar through Transition Advisors, you'll receive a link to that evaluation in an email later this evening. Once both of the requirements are met, the certificate will be emailed to you within 10 business days. Now, in order to fully participate in the webinar today, please take just a moment to familiarize yourself with the GoToWebinar control panel. You should see that on the right-hand side of your screen. The orange arrow at the top of the control panel will minimize it. And during the presentation, all participants are muted, but you can communicate with us by using the question box toward the bottom of the panel. Just type your question into the box and click send. Questions are important to us, and Joel will address all of your questions, time permitting, at the end of the session today. Finally, I'd like to remind you that Transition Advisors offers a free 1-hour CPE webinar each month. You'll see a list of some of our upcoming topics, including growing your firm through new practice niches, the how, when, why, and with whom of mergers, and also a 7-step roadmap for your merger, acquisition, or sale. Registration for each of these, in addition to all of our other CPE sessions, can be found on the CPE courses section of transitionadvisors.com. Now, before I turn it over to Joel, we'll go ahead and start with the first of today's polling questions. The first question is, how many partners are in your firm? And you'll see here that the options are 1 to 2, 3 to 8, 9 to 20, or 21 plus. And we'll give everyone just a few seconds to answer this question. Okay, I'll go ahead and close this first poll. Joel, it looks like 78% of the folks on the call today have 1 to 2 partners in their firm. Another 14% have 3 to 8. 5% are in that 21 plus range, and then the remaining 3% are in the 9 to 20 range.
Okay, wonderful.
Okay,
well,
and so with that, I just wanted to remind everyone that I did send, there was a link in the presentation or in the reminder email to today's presentation if you wanted to download a copy, but I'm also going to send that link now via the chat function. So you can click on that to get the PDF if you'd like, and go ahead and follow along with today's slides. So now I'd like to introduce our presenter for today's session. Joel Stinken is the President of Transition Advisors. Thank you all so much, and I hope you enjoy the webinar.
Thank you very much, Nikki. I guess you'll give me the proverbial show my screen shortly. Welcome, everybody. For those who have been with me before, welcome back to Elm Street. I'm still Freddie. And today we're going to be speaking about how to value an accounting firm. We're going to focus most of it on if I'm selling externally, not to a partner. And we'll focus some of it on with a partner. Nikki, I still don't see the show your screen part.
Okay, let me take it back and then send it over to you again.
Okay.
Okay, let's try this one more time, Joel. Do you see it now?
And there she blows. Wonderful. Okay. So thank you again, and sorry for the slight delay. As we said, today's going to be about valuing an accounting firm. And whenever I teach this class, which seems to be one of our most popular sessions, both when I do it here or for the AICPA, people come to this session usually with 3 questions. The first one is, what is the multiple? The second one is, what is the multiple? And of course, the third one's, what's the multiple? And we're going to talk a lot about that today. You're going to be able to leave knowing what that is today. But let's keep in mind that the multiple is the effect. Today we're going to be focusing on the cause. I never turn a CPE session into an infomercial, but I do think it's important to understand a little bit about the background of the teacher. I'm the president of Transition Advisors. The only thing we do, I help accounting firms buy, sell, merge with each other, partnership agreements, succession planning, growth strategies through mergers and acquisitions. Over the last 26 years, I've been involved in over 750 closings of accounting firms. So what we're going to be sharing with you today is taking us 26 years of going through it, making mistakes, watching people make mistakes, and hopefully not making the same mistake twice. That's enough of the propaganda, and this is just more of it. These are some of our fabulous team members that are all over the country and in Canada and all that wonderful, great stuff. But we're really here to talk about valuing a firm. Whenever you're selling or buying a practice, whether you're selling it to partners or staff, it's important to remember if there's 50 things we need to think about when we're doing any of these types of transactions, the smartest person in the room is only going to think of 35. We're not going to get you to all 50 today because the uniqueness of every practice is so substantial that while we can create a lot of parameters and things to think about, the uniqueness of those practices requires you to have some flexibility in regard to certain aspects of it. You know, I write for the Journal of Accountancy, Accounting Today, and most of the trade magazines. And if you get them and read them like I do, you'll never see one come across that doesn't speak a lot about succession and acquisitions and mergers. What's going on out there? Barry Melanson, the head of the AICPA, was quoted last year as saying that the AICPA expected more mergers and acquisitions over the subsequent several years than in the combined cumulative history of the profession. So there's a lot going on, and some of it stems from the economy. In 2006 through 2008, for example, the economy was very robust. We were growing like weeds. The biggest problem the profession had, staff. People had the business. They didn't have the staff to get the work done. Then 2009, when the economy hit the fan, suddenly growth became very challenging. Heck, collecting your own billings was a big enough challenge, let alone growing. So it was a challenge, and when the economy goes bad, M&A growth becomes more attractive since there's less organic growth. But here we are in 2015, and things are kind of in between. We're starting to see a lot of growth again, and staffing is back to being at a premium. The greatest commodity in public accounting today is young talent with a book of business. The second greatest commodity is young talent. So what's driving the M&A action is a couple of things. Niche development. People, wanting to merge with firms and acquire firms to cross-sell additional services. Clearly, though, the driving factor in all of this right now are the baby boomer generation. There's startling statistics. If you're not a member of the PCPS division, I'll ask you why, but join and go look at the 2012 succession survey. You'll see crazy numbers. Numbers about over 67% of the current managing partners of accounting firms want to slow down in the next 5-6 years. We're facing the greatest turnover of the profession that we've ever had at a time that we have the smallest quantity of new people coming in. So when you have growth, which pressures you to have enough staff to do the work to begin with, and now we're replacing partners, seniors, and managers that are going to be slowing down, this is having a huge impact on M&A. It's why there's so many more people looking for a succession solution. What scares me is how many people aren't that should be. And one of the questions I get often when teaching this class is, how has that affected the marketplace? Is it a buyer's marketplace or a seller's marketplace? And let's address that up front. If you're a small accounting firm in a densely populated part of the country, it always has been, it always will be, a seller's marketplace. Now, I will say values are much less now than they were 10 years ago, let alone 20 years ago. But it's still very active of a seller's marketplace. If you're in greater D.C., L.A., Texas, Chicago, places like these places, there's a lot of potential succession solutions for you. And when you only have a $300,000, $400,000, $500,000, $600,000 practice, there's many firms that can acquire you with no incremental increases in overhead. Therefore, highly, highly profitable acquisition. If you're 30 miles outside of Boise, Idaho, you might be in some of the most beautiful country we have, but there might be one accountant for every 3 zip codes. That's where supply and demand changes. And it's very much a buyer's marketplace in a rural area. Where the greatest change has taken place are the medium-sized to smaller firms. Let's say the $3 to $10 million firms. Look at a city like Boston. Boston has over 40 firms between 3 and 10 million in the greater metropolitan area. But there are only 4 firms large enough to be their successor. Of those 40-plus firms, I'll guarantee you at least 2/3 of them, if not more, do not have the talent on the bench to replace all their partners. So many of them are going to be forced into looking at an external solution through an upstream merger. When you have 40-some-odd firms looking for a solution that only 10% of that number can sustain 4 or 5 local buyers, it's very much becoming and has already become a buyer's marketplace. So the smaller the firm in the more densely populated part of the country, the more opportunities you have as a seller to identify a buyer, and the greater the market is for you. In a more remote area or in a larger firm, there's less solutions. As a result, it's more of a buyer's marketplace. But what won't change is, at the end of the day, accounting firms have limited methods of growth. We can grow one client at a time, which in a good economy is fantastic. In a bad economy, treads water. We could develop a marketable niche to cross-sell our clients additional services. We all see them: wealth management, IT support, litigation support. There's so many niches that we're all pressing right now. Business valuations, it's a way of developing additional revenue from the same client base or attracting new ones. But by far and away, the fastest way to grow is still through a merger or an acquisition. So today, as we focus on value, I'm not focusing from the buyer's perspective or the seller's perspective, because they are the same perspective. It is what it is. But before you can really talk a lot about how to value a practice and the multiple, you need to talk a little bit about the alternative deal structures that most people use. These 5 on your screen today are the most often used. The first one is a straight sale. Now, I am not referring to someone who sells you the practice and goes to Boca Raton the next day. What I'm referring to and hoping to see is someone who's selling their practice, not looking to stay on as your partner or work full-time, but hopefully staying on to do a proper transition. That's a straight sale, not a whole bunch of explanation needed. A buy-in to buy-out is a rare deal, but still done occasionally. That's where the buyer will acquire an equity interest into the seller's firm with a buyout. Let's take an example. Let's say that Kay has a $800,000 practice and I have a $200,000 firm. The new firm's $1 million. For me to have been a 50% equity owner, I needed $500,000, but I only had $200,000. So initially, I acquire $300,000 from Kay to do my buy-in, and then Kay retires in 3 years. I buy her out. A buy-in to a buyout. There are times where the buyer will use their practice as part of that acquisition on the buy-in. Other times, they'll keep both practices separate from each other. A merger to buyout is the more often type of transaction. It's very similar, except there's not an initial acquisition. So if we use the same example where Kay had $800,000 and I had $200,000, we merge together. I'm a 20% equity partner, and when Kay retires, I buy her 80% out. A merger to a buyout. One of the types of deals that is still not the majority of deals we work with are number 5, a two-stage deal, which I'll explain in a minute. But a much more popular thing than we've ever seen before has become the cull-out or carve-out sale. There are 3 main types of carve-out sales that we've been involved in the last few years from consulting. One is the people who either want to keep a niche and sell the traditional accounting work, or the opposite, sell the traditional accounting work, the niche, and keep the traditional accounting work. Here's a great example. Last year in the Philadelphia area, we had a firm that was doing, it was a firm doing about $1.2 million, but they also did a very good wealth management practice. They had a couple $100 million under assets. The gentleman who owned the practice loved the wealth management, really did not like the accounting work anymore and the deadlines. What we ended up doing for him was we sold the compliance part of his practice, the traditional accounting and tax work, to a multi-partner firm that wasn't doing wealth management. The gentleman who owned this practice signed a non-compete in the traditional accounting. The firm that acquired his practice signed a non-compete in wealth management. To the world, they actually moved in together and held it out as a merger of specialties, where one firm cannot stay on top of the day-to-day changes of the stock market and all the constant tax law changes. So they've merged together, and John Doe is going to focus on the wealth management, and Jane Smith is going to focus on the opposite side. It's a wonderful thing. So we've helped people sell a niche and keep their traditional stuff, or the opposite, one type of cull-out sale. Another type of cull-out sale is kind of a stepping stone to succession. For example, in one of our Midwest offices just recently, we had a firm doing about $1.6 million. Two people owned it. One of the gentlemen didn't want to give up everything. He had a small amount of clients. They weren't even his best clients. Matter of fact, some of them were the worst paying, and they were his oldest clients. He had about 150,000 clients that he just loved working with. He called them out. So he sold the rest of his practice, but retained the right to service this $150,000 worth of practice. Matter of fact, the successor firm even gave him free use of their office to work that practice that they kept. Why? Because while he's there, he's the glue that cements the relationship for the other $1 million plus that was sold. So there are people that are keeping a handful of clients or a minority portion of their practice, frequently giving the same buyer the first right of refusal to buy that second portion out at a later date, but it's kind of a cull-out sale. The radical cull-out sale we've had to do for some firms who have failed at an internal succession plan. For example, there was a firm in Texas we did a retreat for about 3 years ago that had 8 partners, 6 of which were all looking to slow down in 7 years or less, and they had very little talent on the bench, but they had enough to replace 3 of the 6, but not all of the 6. We, of course, recommended to them to consider an upstream merger, but they absolutely did not want to do that. They've spent the last 3 years hiring every headhunter and executive recruiter and everybody they could, trying like heck to develop the talent. As of just a month or 2 ago, they recognized they could not accomplish it. Once again, they said, what can we do? And I had suggested an upstream merger. When they still were hesitant to do that, the only thing we were able to come up with was we took $1 million of their lowest paying clients, which probably took up about 40-somewhat% of their time. Their basement of clients was a smaller firm's ceiling. We identified a smaller firm who coveted those clients, and we culled them out and sold those clients to them. We held it out to the client bases, explaining that because of the more robust peer review process the larger firm had to go through, the fees would have had to been dramatically increased. Instead, they worked out an arrangement with this affiliation with this other firm who's going to be able to keep it the same. Bottom line was, by selling out their basement, they created the capacity they need to replace the partners. So it's kind of like a surgery where you kind of cut off the leg by the ankle in order to save the rest of it, so to speak. But those are the less often done. The 2-stage deals become the most powerful and most frequent deal we've done in the 60 to 70 deals we touch a year in consulting. A 2-stage deal is designed for a practitioner who is, let's say, 5 years or less from slowing down, didn't want to give up control or income right away, but wanted to commence their transition. You know, most people recognize that your clients take a long time to transition, especially most of you on the phone are small firms, which are partner loyal firms, not brand loyal firms. They take even longer to transition, especially when we only see most of them once a year. Can't transition them through the cloud and the phone and email. You got to transition them face to face. But many people were fearful of taking on the accountability of merging into a bigger firm and becoming this clock-punching employee. As a result, they put off their succession. A 2-stage deal cures that. Think of it in this way. In order to set it up, we start by taking the seller's net. So let's use an example of a recent closing we had in Florida. We had a firm doing around $500,000. So it was a small firm. including perks, benefits, and the kid's cell phone. The gentleman who owned it was netting 45%. In order to make that net, he had a full-time professional, a full-time clerical, and a per diem during tax season. In a small firm, we only focus on the owner's net and the amount of labor they use. If it was a multi-partner firm, we would have shifted from the labor they use to their own chargeable hours. But let's stay with the small firm example. And then this particular gentleman wanted to work 3 more years full-time before he retired. So we set the stage, $500,000 net 45%, had 2,800 hours of total of professional time, including the per diem, 2,200 hours of clerical time. The successor firm said to him, John, you come on in with me. I'm going to take over all of the costs of your operation, rent, labor, everything. I'm going to provide you the same amount of labor you used in the past. And right now you're making 45% of what comes in. I'll hire your entity as a consultant and pay your entity 45% of what comes in. So we're basically keeping the seller whole in income by paying it to his entity. His entity continues to pay his car lease and his medical insurance and feed his retirement plan. The successor firm gets a current deduction. Now what's interesting here is we don't really care how many hours the seller works in this situation. I'll explain to you why. We promise to give them the same labor, the 2,800 hours of professional time and 2,200 hours of clerical time. The seller puts in 2,000 hours or 1,600 hours. That doesn't affect the buyer. What affects the buyer is the support they have to give. That's what enables the seller to still have the freedom to come and go as he sees fit. So basically, we've said to the seller that during stage 1, we're going to keep you whole in income, right? We're going to you'll still have the same control in everything. There's only 2 ways this seller would make less money during stage 1. The first way is if the fees went down. But if he didn't do this deal and the fees went down, he'd be hurt worse. For example, his largest client's a $50,000 a year real estate client. If he doesn't do this deal and loses that client, he loses $50,000 of income. All of his other expenses were pretty much fixed. Now he only loses 45%. The other way he'd make less money is if he suddenly needed more labor than he used in the past. But if he didn't do this deal and needed more labor, he'd have to pay for it. Well, in the highly unlikely event he suddenly needs more labor in the stage 1 of this 2-stage deal, the buyer will supply it and will get compensation for it. So from the seller's perspective, they kind of have a built-in practice continuation agreement, except it's on steroids, because we're already commencing the transition. We've already moved into the same roof. We're already sharing the records. We've mitigated our risk of lost clients from a fee perspective. Usually the successor firm takes over the admin, the billing, the collections. It's done under their name. It's held out as a merger. So the seller gets backup and support, usually puts in less time since the administration was taken over for him, which he'll use to develop new clients, grow the practice, transition them, or have a higher quality of life. And by having this stage 1, we've maximized client retention, which means the seller gets paid more money and the buyer makes more money during the payout period. The reason the buyer does the deal is pretty simple. In this particular case, the buyer kept the senior, but had the capacity to replace the clerical and to replace the per diem. So between the savings in rent, software, malpractice, labor, this gentleman who's buying the practice is saving $100,000 in overhead. Now, I will tell you, in the 11th hour, the sellers called us up and said, you know, they're saving $100,000, I should get a piece of that. And we politely reprimanded him, saying, no, you shouldn't. You got everything you wanted: control, income, backup, support, and succession. The fact they're getting money is part of the reason they're doing the deal. They're taking on all the liability and exposure. They're investing their time into meeting the people, infrastructure. They need a reward. So this is a 2-stage deal. Stage 1 terminates on a back date that's been mutually agreed upon, or God forbid a health issue comes up, and that's stage 2. Stage 2 is the buyout. See, we can't keep you whole in income and pay you for your equity at the same time. So by deferring the purchase price during stage 1 to stage 2, we can help someone maximize the value of their time and maximize the value of their practice. This is when the retention period commences on the onset of stage 2, because during stage 1, the seller is still chief cook and bottle washer. But the seller usually still stays on in a part-time role, which will usually pay, for example, a third of what they're billed out for. And we usually will give them a new business incentive program to continue to bring in new business and get well paid for it. So a two-stage deal, stage one's like the merger period, stage two's the buyout period. And that brings us to what is the multiple. But before we do that, let's make sure you get your CPE credit. So, Nikki, let's do the second polling question.
Okay, the second polling question is on your screen now. This one is, which best describes your personal situation over the next 5 years? You'll see your options there include, I'm seeking to reduce my time commitment, I have partners seeking to reduce their role, I'm interested in acquiring, or none of the above. We'll give everyone just about 10 more seconds to select their answer. Just keep in mind you have to answer 3 of the 4 polling questions in order to get your CPE credit for today's webinar. Okay, I've closed the poll. The results are there on the screen, Joel. It looks like about 39% of the folks today are seeking to reduce their time commitment. 26% want to acquire, and 10% have partners seeking to reduce their role.
Wonderful. Let's hope that this session is going to bring value to everybody on both sides of the fence. So here we are. What is the multiple? As I said before, the multiple is really the effect. Let's focus on the cause. In today's presentation, I've broken it down to have 5 main variables that I look at, and how they interact with each other is how we're going to value an accounting firm for an external sale. We're going to talk about an internal sale shortly, but on an external sale. Now, for those of you who bought the book that my partner and I recently wrote, I talked about 7 to 9 variables. We got paid by the page, forgive me, there's really only 5, so we're going to do the Reader's Digest version today. So the first variable, not because it's the most important, just because it's number 1 on the screen, is cash up front, if any. I will tell you in 2015, where credit is more challenging than it used to be, collections are slower than we've been accustomed to, down payments have become less than they used to be. For the range of deals that we've consulted on, the range of cash up front has been from 0 to 20%. So if you have been reading about these brokers that are telling everybody they're going to get them 80% cash up front and everything, I'm sure those deals happen, but I'm also sure that those are the overwhelming minority of the deals. Most of the deals we do are 0 to 10% up, 0 to 20% up front. I've had more at 0 than at 20, but I've probably had more at 10 than at 0. Now, cash up front depends on more than just how deep my pocketbook is. For example, and a lot of people don't think enough about these consequences, but the time of year can have a heavy impact on my willingness to put a certain amount down. For example, if you have a very heavy tax season-oriented practice, and we're closing July 25th, and you've already billed out 75 to 80% of the revenues for the year, don't ask me for money up front now. I might be carrying this practice for 6 months at a cash flow loss. So I might be more interested in coming up with a balloon payment in January or May, but coming up with a substantial down payment in July when I'm not going to start collecting any real money for 6 months could be a very challenging request. It's a cash flow question. When does the cash come in? How quickly will I get a return on this investment of the down payment, which can be impacted heavily by accounts receivable. If your accounts receivable are just really challenging right now and they kind of remind you of, let's say, Charlie Manson, and you say to the buyer, hey, the first dollars that come in from each account have to pay back my receivables first. It's very hard to do that when you have slow receivables and get a down payment. So believe it or not, the treatment of accounts receivable and work in process could have a big influence on the quantity of the down payment you get. Sometimes we'll get someone a down payment but ask for a payout period on their AR and WIP. It really depends on the nature of the deal. So cash up front could be impacted by many different things, but that's going to be our first variable. The second variable on an external sale is the retention period or the guarantee period. And what we're referring to there is how long after closing if a fee goes up or down from the original clients acquired, does that impact the purchase price balance the buyer owes the seller? I will tell you, on external sales, in over 750 closings, I don't recall one that we ever sold. Oh, I do recall one, forgive me, one only that was ever sold with no retention elements. Internal sales, when we're selling to a partner, that's different. We're going to talk about that. But an external sale, especially the smaller firms, which are filled with partner loyal clients, traditionally have a retention period. So the question becomes, in most of these, how long is the retention period? So let's break it down into three main categories that we'll see. The first one is a collection deal or an earnout deal. So let's say, for argument, I was getting the proverbial one time paid out over 5 years. Most transactions would turn that into 20% of collections for 5 years. Now that includes fee increases, special projects, everything that comes from the original clients. I say that because it's very unfair to try and negotiate a deal with a seller and say, hey, this client went out of business, I'm not going to pay anymore, or this one doubled its fee, you're not going to get that either. A good deal is a fair deal. If they're going to participate on the downside, they should surely participate in the upside. And 80% of the deals we've done approximately have been earn-out deals, where the entire payout period is based on a percentage of collections. Doesn't mean there's not money up front. Maybe I got $100,000 up front, then I got paid 20% of collections for 5 years, less $50,000 in years 1 and 2. So part of the money up front all the money up front gets credited off that purchase price. Other deals have a limited guarantee period. That's where, for example, maybe we'll lock the purchase price at the end of the first or second or third year of the payout period. In a two-stage deal, remember, the retention period always starts on the onset of stage 2. So at any rate, the question that really we need to look at is, what's the best deal for the buyer? What's the best deal for the seller of the three most popular structures? That being a collection or earn-out deal, a 1-year retention period, or a 2-year retention period. We've been reviewing over 90 different deals that closed years ago to use as a comparison for an article we're preparing for the AICPA, a little case study on what the results would be. And so far the results have been really black and white and 100% counterintuitive in some ways to what most people would think. For example, the worst deal for the seller, according to what our statistics and research has showed on these very specific deals, was the 1-year retention deal. Here the seller was saying to themselves, I got to minimize my exposure and lock my purchase price at the quickest point in time possible. And let me tell you why our research has showed us that deal worked out the worst for the seller. See, one of the problems you have when you're selling an accounting firm is you're selling it to an accountant. And what many of you who are CPAs didn't know is when you sat for your CPA exam, there was a chemical in your cushions that came up your you-know-whats and made you all real conservative. I have a handful of clients that will tell me what's right about it. I have a gazillion clients who will tell me how everything's going to go wrong. So when I tell a buyer that the seller wants to lock the purchase price in the first year, many times these buyers envision Moses parting the Red Sea and taking all the clients away in month 13. So what do? First thing they do is they lower the offer they would have made because they impute this greater risk factor. The second thing a good buyer smart buyer would do is shake the tree really hard, because you don't want to lose a leaf in month 15 that you could have lost in month 5. So they end up instituting their changes, so the seller ends up getting a lower multiple, locked in at the lowest point in time by a buyer who's the least patient in the transition. A 2-year retention period, again counterintuitively, worked out the best for the buyer. And here's what our research has taught us about that. If I was to acquire Nikki's practice today, the true measure of success of that deal would be 2017. Because if I acquire a practice today and I do the work in 2016, if they come back in 2017, they're mine. They've gone through the change, they accepted the change, and they came back a second time. The truest measure of client retention is year 2. So what some buyers have found is by locking the purchase price at the end of the second year, they end up stopping the seller from participating on the growth that occurs in years 3, 4, and 5 from fee increases, special projects, what have you. But yet they've locked it in at a time that they feel very secure about client retention. By the way, an economy clause, which you see on the screen, is sometimes in a 2-year retention period or 1 year, you might ask for an economy clause where, let's say it was a 2-year retention deal. You say, hey, if in year 3 a client I lose to another local accountant, shame on me, no credit. But if I lose them because they died, relocated, sold, went out of business, you'd have lost them too. Like some sort of ratable reduction for an economy clause, which is usually a 1-year clause at the end of the full retention period. So a 2-year retention period worked out to be the best for the buyer. And by the way, even a 2-year retention period you have to negotiate. Is it an average of the first 2 years? Does it include special projects? That's another whole story. If we have time, we'll come back to it. What worked out the best deal for the seller was the straight collection deal, the one they took the greatest risk. Reason for that was the average offer from a multiple perspective, because the buyer was taking less risk, was much higher. So how many clients would the seller have to lose to get back to where they would have been in a 1 or 2 year guarantee deal? The buyer had no risk of client loss affecting them, so they weren't racing to make changes. They were more patient in the transition. So what ended up, and again, if I've kept the client through the second year, what's more likely in years 3, 4, 5, and 6? Fee increases or continued attrition? Typically fee increases, special projects. So as counterintuitive as it could be, the longer the retention period, the more it worked out in the seller's benefit from the overall packaging. So the first variable is cash up front, if any. The second one is the duration of the retention period. The third one I think is the least understood, and that's profitability. And the reason it's not understood is because it's the buyer's profitability, not the seller's. I was teaching this class to a group of CVAs who just exploded at me when I told them I don't really care what the profitability is of the practice when I'm valuing it from the seller's perspective. I only care from the buyer's. And of course, as accountants who are CVAs who constantly measure value based on profitability of the business that's their clients acquiring, it was inconceivable until I gave them the following example. Let's say that 5 years ago I had a practice. I was doing $300,000. My wife, Kathy, answered the phone. We were operating out of the house. My net was what, 85%? But then we were tired of people knocking on the door, so I took an office. Kath didn't come with me. I hired an office manager, and I decided to take off Wednesday afternoons to play golf with the dentist and hired a per diem. Now I'm netting 40%. At which point in time was my practice worth more to you as a buyer? See, it's irrelevant. If you could absorb my practice with no incremental increases in overhead, it's very profitable. If I ask you to pay me in goodwill, but only pay me in 4 years and have to deduct it in 15, if I tell you you have to keep my office manager because she's been with me for 40 years and she has 16 weeks paid vacation and makes more than you do, and all these things do what? They mitigate profit. It's the buyer's profit that determines how much they can afford to pay and still make money, not the seller's profit. The same problem people have when they do due diligence and missing this is looking at billing rates on a piece of paper. A great example is we had a 2-partner firm in New York, very unusual in that they had no professional staff. It was 2 owners and a bunch of clericals, both wanting to get out at the same time. During due diligence at one point in time, the buyer called me up and said, you know, Joel, we just realized we have a problem. These partners are only getting $200 an hour for time. We get $300 to $350. So I said to him, well, you just looked at in due diligence, not who's going to hold the client's hands, but these 2 partners have no staff. You have managers, seniors, juniors. The type of work they're doing, who would do that in your firm? He said, almost everything they do is senior work. I said, what do you get for your senior time? He said, $150 an hour. I said, I guess you're getting $200 now. See, even the hourly rates are a piece of paper. You have to convert what work they're doing to how you're going to do it. What time and effort, what level of staff will you leverage it to? And it's not always nirvana. Maybe your quality control process is more robust and it will take you more time and effort to derive the fees. or maybe you'll be able to leverage the work down, have better efficiency, better technology, and take less time to do it. Right? So you need to convert profitability from the sellers to the buyers, the billing rates from the sellers to the buyers. And remember, if you make an offer, if you don't say how you expect to treat it from a tax perspective, you've made a half-empty offer. Very few deals are done in this country 100% goodwill because of the tax consequences, but that's part of the profitability. That's the variable number 3. Variable number 4 is the duration of the payout period. The smaller the firm, the shorter the payout period. So firms, let's say under $1 million, are usually, let's say, 4 to 7 years. Most of them are 5 and 6 years. A firm doing $4 or $5 million, you're looking at a 10-year payout most of the time. Right? So the duration of the payout period is the 4th variable. So cash up front, if any, is variable number 1. The duration of the retention period, variable number 2. How profitable the transaction is, variable number 3. How long is the payout period, variable number 4. Number 5 is the multiple. Think of it in this formula. The less money up front, the longer the payout period, the more profitably it's structured from a tax perspective and otherwise. The less money up front, the higher the multiple. Let's take an example. Let's say all of you on the phone were a buyer and all wanted to buy my firm. And let's say for the premise is all of you could absorb this practice with no incremental increases in overhead. You have the space and the capacity on the professional level to take on the work. Highly profitable. If I said, pay me 15% of collections for 10 years with no cash down, structured as a consulting agreement, would you do the deal? I would do that deal in a heartbeat, even though that's 1.5 times. And I don't even remember the last time we had a firm go for 1.5 times. It's been years because the market's shifted so much. Now, some of you might say, well, Joel, it's not really 1.5 times because it's a 10-year payout. You're not thinking of present value. You're absolutely right. I'm not thinking of present value. I'm purposely ignoring it. I'm ignoring it for 2 reasons. Number 1, I hate present value. I mean, I get it, but it always seems to beat me up a little. Well, that's a secondary. The main reason I'm ignoring it is present value is based on what? An interest factor. If you bought my practice, and over the 10 years it kept growing, and the fees went up, that's better than any interest factor. So present value doesn't apply. The reason I pay 1.5 is because I have no risk. I'm paying a small portion out of cash collections. It's a no-brainer. Now that same seller comes back to you and says, well, you know, I want to be paid out in 5 years. And whatever you do, the second year locks the purchase price. I'll still give you a current deduction, but I want 10% up front. Well, depending on where you are in this country, generally speaking, you're looking at 0.8 to 1.25. Same seller says, I want to be paid out over 3 years. I want 20%. I want goodwill. I want a 1-year retention period. There is no place in this country I can get that person one time. No place. That same seller said, I want all cash at closing. I couldn't get them 50 cents on the dollar. So here, the same seller, I could get 100 buyers to do the deal in a blink at 1.5 times, and I got nobody who would touch it at 50 cents on the dollar. How do you start with multiple? Multiple is the effect. So when you negotiate a deal, you can't negotiate one variable at a time. You got to use the scales of justice and put it all out there. This is how much up front. This is the treatment of AR and WIP. This is the tax ramifications. This is the retention period. Because when you negotiate one variable at a time, suddenly then they say, well, okay, I'll accept that multiple, but I want goodwill and I want a 3-year payout. Well, now the whole thing just crumbled. So it's all packaging. Now, one other thing I have on the slide here before we take a break for a polling question and to talk about buying out partners is a lot of times people say to me, well, isn't a tax client worth less than a business client? So I always ask them why they say that. I usually get 3 reasons. The first one is because it comes at a terrible time of year. I told them you chose to be an accountant, get over it, never ask that again. Second reason that people will say to me, well, there's really only mainly 2 reasons. The second one's a pretty lucid point, and that is we have a higher attrition factor in our 1040 practice than we do in our business practice. That's a retention issue. See, on a pure hourly rate, most people realize better on tax work than accounting. Most people have less exposure in tax work than accounting. Most people have better collections in tax work than accounting. but there's always the stigma of 1040s. Well, the reality is, if I'm paying you a percentage of collections, I don't reduce the value of 1040s versus regular business clients, because if I lose someone, I stop paying for it. But if you have a practice that's filled with annual clients, it could be all annual business clients, but they're just annual clients, well, if you do a short retention period, 1 or 2 years, it's going to greatly impact the multiple. So tax versus accounting, well, annual work versus repetitive work is an issue from a structure perspective. If it's structured on retention, it doesn't impact the multiple. If it's structured with a short retention period, it will impact the multiple. So keep in mind real briefly that in large deals, furniture, fixtures, and equipment's figured in. What we've been talking about are small deals. When you start talking about $10, $20, $30 million firms, and we do our share of them, everything's different. Multiples are less, payout periods are much longer, assets are paid for. In small deals, furniture, fixtures, and equipment's a throw-in. Sellers usually participate in fee increases. The only thing they won't participate in is if a client refers a client. Unless the referral comes through the seller, that's usually the fruit of the buyer's labor. So why don't we look at the third polling question, then we could talk about internal sales.
Okay, the third polling question is on the screen now. This is your position in the firm. See the options there. We'll give everyone just about 20 seconds to select their answer here. And again, just keep in mind you do need to answer at least 3 of the 4 questions in order to get your CPE for today. Okay, Jill, it looks like 55% of the folks on today's webinar are managing partners, another 21% partners, and then the rest either staff or other.
Okay, let's hope everybody gets some value. All right, let's talk about selling externally versus internally, okay? There's a couple of things to keep in mind here, and obviously our time's a little limited. One of the other classes we teach, and there's a whole list of our classes online, and we email them out, is more purely about internal succession, how we buy out partners, internal succession readiness, things like that. This is kind of a Reader's Digest version of that. First of all, an internal sale almost always goes for a lower valuation than an external sale. We don't usually charge a partner the same thing we charge a stranger. Plus, for example, if Nikki, Kay, and I all became partners 5 years ago and the practice has grown by 35%, aren't all of us part of the reason? So there's a sweat equity part of it. So number one, it's not usually structured at the same value. It's usually a lower value. What concerns me is how often there's no retention period. We sit there and say, well, it's with the same firm, therefore when you retire, you're retiring at fixed compensation. I'm okay with that if there's a couple things you institute. For example, you should have at least a 2, if not a 3-year notice requirement before someone reduces their time commitment, so that, and not only 2 to 3 year notice, but a very strong transition plan that says, okay, over these next 2 to 3 years, we're going to follow this transition plan. If we all give the proper notice and follow the transition plan, then it's incumbent on the firm to be responsible to keep the clients. But you don't want to be in a situation where we each have our own book of business. You almost never deal with any of my clients. I give you no notice, I leave and get a fixed purchase price. What's the chances you're going to keep all those clients if there's not a proper transition? So I'm okay, not a huge fan, but I'm okay of having no retention period in these small 2 to 5 partner firms, but I'm a huge advocate that you better have notice and you better have a transition plan. In real large firms, it's almost always the case when I'm dealing with my 10 to $200 million firms, they almost always have a 2-year requirement and all these types of things. Of course, we also have to have buyouts for death, disability, and penalty buyouts. Most of the time, death and disability we cover through insurance. Penalty buyout might be a loss of a license, certain exceptional situations, some of which could cause a reduction in the valuation, some of which might keep it whole, but force the buyout to take place. What's really changed dramatically is so many things. The values have come down in both external and internal sales. over these last 10 years, like especially the last 3 to 5, like never before. But also, equity is becoming of very diminished importance in most large firms. We just finished reviewing and updating a partnership or ownership agreement. It was actually a membership agreement for an LLC on the West Coast of a top 100 firm. Their firm, equity means nothing. It's one partner, one vote. Compensation and profit isn't based on equity, and your buyout's based on comp, not equity. So first we have to understand when we're buying out partners, what are we buying them out on? Smaller firms might buy them out on their equity interest. They might buy them out on their book of business. They might buy them out based on compensation. We're going to show you some statistics on both of them. So when I say compensation, by the way, for example, this large firm in the West Coast that I reviewed, the way they do buyouts is they look at your last 5 years' income on an accrual basis. They average it. They multiply that by 2.5 times, and they pay that amount over 10 years on a K1 and capital over 5 years. So a new trend in large firms, especially top 100 and G400 firms, is the buyout is a multiple of compensation. Smaller firms, it's still predominantly a buyout on equity or book of business. So I get asked a lot, which one's better? And my answer is whichever one you like is better, as long as you still have notice and transition. But there is a litmus test that you should apply to make sure your internal buyout works and makes sense. And here's how that works. It's based on the following concept. As accounting firms, we've never said to our client, hey, we just did due diligence on the business you want to buy. We figured it all out. And if you buy the business based on what you told us, after our homework has been done, we realize you're going to lose money, maybe break even for the next 5 years. It's a great deal. You should do it. You never said that. How can we then say that to our partners? If we're going to motivate people to be our successor, it should mean when I retire and you buy me out, you make more money. If not, what's your incentive to buy me out? So here's a litmus test you could apply to your buyouts to make sure they make sense. Take a partner's retiring's gross income. Let's say I'm making $350,000 all in. Then subtract from that the cost of replacing my labor. Let's say, for argument's sake, it's going to cost, including perks and benefits and taxes, $150,000 to replace my labor. That leaves $200,000 left for the firm. So the question is, how much of that $200,000 do the remaining partners get? How much of that $200,000 does the retiring partner get, and for how long? Based on that premise, the retiring partner is getting paid for their years of sweat equity, and the remaining partners are making more money. If your buyout fails that litmus test, that it comes out as a negative number, your buyout stinks. And don't be surprised if your partners are unwilling to buy you out. So you really need to think about this. This is why most internal buyouts have long payout periods. For my 5, 6 partners and larger, most of them are 10-year payout periods. I've even had some at 15 that used the capital gain, so it became a non-issue. But the bottom line is, it's more of a business deal on external sale, and they go for bigger bucks. An internal sale, you should be rewarded, but your remaining partners have to succeed. Be careful also in internal sales. How many partners can you replace at the same time? See, it's not an economic issue if the litmus test was passed. It's a realistic issue. If you're 6 partners and 3 want to slow down in the next 5 years, you better have an incredible bench, because how are you going to replace this many partners? And be careful that you don't have partners who reduce their time commitment but still maintain the same income and control. That causes a lot of animosity in firms, unless both owners, or it's a small firm with all owners doing that. Also, a pet peeve of mine are people that replace the role, not the body. I was with a firm consulting not too long ago in the Northeast, and they were telling me how that they're about to lose one of their partners, but how they have this great manager in the tax department that's been bringing them business they couldn't wait to promote. I said, sounds fantastic. Who's leaving? They said, the quality control partner. Well, what does that mean? I'm going to take my best rainmaker in the tax department and make him my QC partner? You can't replace the body. You have to replace the role, right? And you have to have the capacity to do it. If I'm losing 20 of my partner group, everybody's working full time. How am I going to replace them? And those who are waiting are going to find it to be more challenging. I mean, you look at a place like I said before about Boston, if there's only 4 firms big enough to take over the 40, if you're number 30 looking for succession, what are you going to get? Make sure you're looking at your ownership agreements on a regular basis. Make sure you have proper notice, a transition plan, buyout terms that pass the litmus test, and a cap on how much can be paid in any 1 year to retiring partners. Caps could be from 3% to 15%, depending on the profitability and size of your firm. But there were firms in late 2008 and 2009 that took huge losses of client bases. Their debt service to retired partners was so substantial that working partners couldn't afford it, and they folded. If they would have had a cap, it would have deferred part of the purchase price and extended the payout period to retiring partners, but it would have eliminated it where everybody lost. Now, according to the PCPs survey, the smaller the firm, the less likely you even have a plan for succession and how the purchase price works. But as you could see, most of these, as you get up in volume, more and more firms are using a multiple times salary. For example, 61% of the $8 to $15 million firms use that, where only 24% will use ownership. By the way, you'll see other has a lot in it too. Most of the others, it depends on the size. The bigger the firm, most of the others have maybe 80% of the buyout figured out based on comp and 20% based on equity. So these are some statistics that show you the trend is for larger firms, buyouts based on a multiple of compensation. When we're buying out somebody on an equity, as you could once again see, very, very rarely will you see someone getting bought out at more than one time. Matter of fact, you'll see more at 50 cents and 70 cents on the dollar than at one time. So the magic is everything's always one time isn't necessarily the case anymore. These are statistics that came from over 500 firms that are buying out partners based on these formulas. Smaller firm tends to get a higher valuation than a larger firm does. So that's an important thing as well. For those that are basing it on compensation, you'll see that the biggest range at one point in time, when this was first done in 2012, which was based on 2011, we actually saw a lot at 2.5 to 3.5 times. Now the bulk of them we see are between 2 and 3 times. Even in just the last few years, we've seen this multiple come down. Very few are over 3 times, and I have more or closer to 2 than I do closer to 3. All these things are really important to value it. You always have to walk the fine line where the successor firm's getting a return on their investment and the seller's getting paid for the years of sweat equity. But so many people focus way too much on the dollars and cents. Believe me, for 26 years, this is all I've done. Dollars and cents are the easy things to work out most of the time. It's the 4 C's that you need to focus on. The first one is chemistry. If you don't want to eat lunch with someone, don't do a deal with them. You have your clients because of you and the culture you created. If you're not comfortable with someone, why would the clients? Continuity is huge. If I'm going to sell my practice to someone who's going to make wholesale changes to the way these clients are serviced, that doesn't make sense. They like the way I'm working with them. So I need someone who's going to at least maintain some level of continuity. Our cultures match up. And I'd say the C that people spend the least time looking at, which they should be spending the most time looking at to a certain degree, is capacity. If we're a 4-partner firm and 2 of us want to leave and 2 of us want to stay, and we're merging into a bigger firm, do they have the capacity to help us replace the 2 that are leaving? Do they have the skill set? Remember, everybody has to win. That's a good deal's a fair deal. It's not one of these things we all have to lose. And you can't negotiate one variable at a time. You need to look at it as a package or you'll beat each other up in the negotiations. If you want to do something to increase your firm's values, focus on the metrics. But believe it or not, embrace technology. The larger your firm, the less interested the big firms are in you if you still have a culture that's not paperless, that's not multi-screens. Try and avoid committing yourself to long-term leases if you're entering the merger world. Because if you have a lease and you make someone else married to it, you're going to end up putting yourself in a position of having a smaller audience. because most of them want to move the practice into yours. So before we do our final wrap-up, let's do our last polling question, then I need about 60 seconds more time.
Okay, final polling question. We'll give everyone just a moment here. This is how long you plan on working full-time before you slow down. You can see the options there, and we'll give everyone just about 15 seconds to select theirs. And while you're doing that, I'll just remind everyone that as long as you completed at least 3 of the 4 polling questions and then you do the online evaluation, you'll qualify for the 1 CPE credit. Those of you that registered directly with Transition Advisors will get an email from me later this evening that'll have a link to that online survey that you can complete. And then I'll email you your CPE certificate within 10 business days. Okay, Joel, I'll go ahead and turn it back over to you.
Okay. These last 2 pages, just some quick things for everybody. I'm a huge advocate and fan of the AICPA's PCPS division. They've put together this entire succession planning resource center. It gives you guides. It gives you chapters to different books that have been written on everything from due diligence to how to choose a successor to how to value a practice to structuring a deal. They give you these calculators to figure out when you should start to plan, how to choose. They help you in determining if you have the bench strength. It's a great website. Don't hesitate to hit it. And also on our website, you'll find that there's some really cool sections, one of which is our resource section. Under the resources, there's probably 70, 80 articles we've written for the Journal of Accountancy and other things on all different topics, case studies, free reports, lists of our CPE. We're not so sophisticated. You don't have to sign in. We don't have a tracking thing. Help yourself. It's all free. Take a look at it. And forgive me, I had such a rambling mouth as usual. I exceeded all the time available. Anybody who sent in a question or anybody who still sends in a question over the day or two, I assure you it will be responded to within the next day at most. I want to thank you all very much for participating in today's session. I hope you all got value out of it. Nikki, does that shut us down? Are we good to go?
That does. Thanks so much, Joel, and thanks everyone for attending today.